So for the record, this is a class on optimal trade entry, which I will be sharing with you guys today. It is going to be a class on how to use optimal trade entry as it was coined originally, and also as I found that I can use it in everyday setups. Okay, there's going to be two parts to this. I'm going to introduce it the first time. I'm going to show you guys how to do it in this class, and then the next class I'm going to be going over examples as well as ways that you guys can use it in more specific situations, right? So, firstly, we need to go over what the optimal trade entry actually is. Who can tell me what the optimal trade entry actually is? Or who can fathom a guess? $79. Okay. Make sure that I can see chat and everybody who's here. All right. So we have Gennaro saying the 79, Jenny saying the 88, premium and discount pricing. Okay. So we have a couple different answers here, but there's only one technically correct answer. Okay. And it's not that any of you guys are wrong. It's simply that I'm looking for, you could say, the most correct answer. Because it encompasses a lot of things, knowing what optimal trade entry is. And let me actually grab my lesson plan here so you guys can actually see what's going on. So let's start with this. So the fundamental theory behind behind the optimal trade entry, right, is based on the fact, right? So and I'm gonna write down these notes for you guys. So OTE, right, is also known as optimal trade entry. Known as optimal trade entry, right? It is essentially it banks on the theory, right, that markets prefer the extreme, right? Markets prefer extremes. So it does have a bit to do with premium and discount pricing, right? So a couple of topics that you guys may want to look into apart from this would be, let me start real quick, would be premium and discount, right? And power of three. But we're going to keep this class extremely simple. Okay, so just write that in your notes, right? Now, this optimal trade entry, right? It banks on the theory, banks on the fact, actually, not the theory, the fact that price prefers extreme retracements. Now, who can tell me why price prefers extreme retracements? Who can tell me why? Who can tell me why? And you guys can unmute your mics. You guys can unmute your mics, or you guys can just talk and chat, whichever way is fine. So mitigating buying and selling orders to sell at the highest and buy at the lowest. Okay, a similar theory, right? Does anybody else have any answers that you guys would like to share? For price mitigation. Okay, so it actually has a variety of reasons why, and let me show you guys why. Can I actually see? Let me see if I can do this. If I can do this, I will be very happy. I don't think I can. Shoot. I was trying to type as well as draw, but apparently I can't. Okay, so going back to what I was saying, essentially, right? It's price mitigation. So when price, let's say it comes up, right? Let's say there was a previous high up here, right? And it broke it. So it took that liquidity, right? It broke above it. Now, what is here? So what kind of orders are here at that previous high? What kind of orders? This is the basic definition of liquidity, right? This is the basic definition of liquidity. So wherever there's a previous high, so for a lot of new people that don't understand what liquidity is, right? Wherever there's a previous high, uh, a previous high. Oh goodness. You know what? I'm just gonna talk because writing all this is gonna take too long. So whenever there is a previous high or a previous low, there's going to be orders at that point, right? Whether, so like for example, if a lot of retail traders, right, they'll see a previous high and they'll put a buy stop above it, right? And a buy stop is literally just if price crosses above it, it'll enter you into a buy at that level, right? So if you have a buy stop there, that's essentially what it does, right? uh, and it'll take this liquidity. Now, liquidity just means money, right? Liquidity just means orders. So it basically means the more people that get their stop loss hit, the more money that goes back into the market, right? So that's essentially what liquidity is. So it's where orders are, right? It's where the majority of orders are. So it's the bunch of orders that are there. So people that enter market execution, people that have buy stops, people that have sell stop losses up here, right? And there's a difference between stop loss and a sell stop or a buy stop. Okay. It's a very, very basic difference. Okay. Now, does everybody understand it up till now? Drop a one in the chat if you understand. Drop a two in the chat if you do not understand. And that way I can re-explain the concept and I can make sure that everybody's on board. And if you're watching on YouTube, please make sure to drop your comment or question in the comments and I'll make sure to answer your question. Perfect. Okay, so it seems like almost everybody understands it. If you have a question, please write it in the chat and I'll answer it as soon as I get a chance. Okay. And don't think that you're interrupting anything, please. It's better for me to answer your question now than to try to answer it later. And, you may have lost money by that point. I don't want you to lose money using something that you don't fully understand. All right. Awesome. So what happens with optimal trade entry is, like I said, right? It relies on price extremes, right? So it relies on the theory of extremes. So price is magnetized toward extreme positions, right? So say, for example, the move starts off back here, it'll, break a previous high, take that liquidity, exit out those orders, right? And then it'll come back down. Now, a lot of people like using the 61.8 Fibonacci, right? So it's around like there, right? The problem with the 61.8 Fibonacci is that a lot of times it is so high up, right, that it doesn't particularly get you good risk reward and it isn't very attractive, right, to be in a lot of drawdown. But I'm going to show you guys a way that you guys can use a different level, right, so that you guys can actually see the theory of extremes in action, right? So let's go to the actual base theory. So the base theory, now that everybody understands that price prefers retracing to extremes, because one, so price prefers retracing to extremes for a couple of reasons, but uh, price prefers extremes because one, more stop losses hit, right? Two, people are discouraged to share profits. So what this means essentially is, right, the more money that is in the pot, right, for institutions to grab, the better, right? I don't know why it's drawing like this. I apologize. Okay, so the more people that get stopped out, the more money that's in the market, correct? Perfect. Now, a lot of people will not follow their trading plan after taking a loss. I feel like a lot of people know that, right? A lot of people know that we don't sometimes we don't even follow our trading plan after taking a loss. Sometimes you re-enter, right? Or sometimes you get very emotional and then you start selling, right? So more people getting their stop loss hit means more money for the banks to fuel up their next move, and that's exactly what's going to happen, right? So these are the more the better. Oh, and here's the third is deeper entries for the banks, right? Deeper entries. That basically means, right, if price goes back down, right? So like for example, let's say price takes off here, then comes back down. This is a close entry to the original entry. Right? This is a close entry. So it'll skyrocket and you have two similar entries where the banks dumped in a lot of money, right? This may also be, limit entries, basically, buy limits or sell limits. And the same goes for the bearish position, right? So let's say the bearish position starts here. It goes down, it takes liquidity, it comes back up, and then it plummets, right? So we have two areas where the banks actually pushed and took deep retracements, right? And those deep retracements are extremely important because the banks need them, right? If the banks don't have these deep retracements, they honestly don't have much of a move, right? They don't have much of a move very simply because they do not have a position, um, a deep enough position for them to re-enter in, right? Banks don't like being in drawdown, firstly, and they don't like sacrificing their capital without getting maximal results. So what does that mean? Getting maximizing their capital. Well, very simply, right? If I was going to spend millions of dollars, whether I'm just throwing out a number here, not actually millions. Well, a lot of banks do spend actually millions of dollars, but if I was going to spend millions of dollars on a move, right, that was going to end up in point, let's say, put it in green. Let's say that it ends up at our target up here. Say it ends up at our target up here, right? Well, if I want to get an entry, I'm not going to enter up here, am I? I'm not going to enter up here, am I? I'm going to want as much money as I possibly can get. I'm going to want as much money as I can possibly get to push my move higher, right? I'm going to want as much ROI, as much return on investment as I can possibly get. So as a bank, I'm going to manipulate price lower, right, by possibly selling here, right? Putting a fat lot for a sell, right? And pushing price lower and then closing out of this sell, right? So I'm going to close out of this sell and I'm going to use the same money that I put up here for this sell and I'm going to do the exact same thing and I'm going to buy again, right? That's essentially how the algorithm likes to price it in. That's exactly how the banks likes to do it too, right? So now that you see this, you need to understand what tool we use to measure this. The tool that we use to measure this, a lot of people know, but a lot of people don't know how to use it. So it's the Fibonacci retracement, right? It is the Fib retracement. Let me get in a better position to draw. It's the Fib retracement, right? And this Fib retracement is used at a certain couple levels that are going to be very important. Okay, so this is where we actually switch over to TradingView, and I'll come back to my whiteboard here in a moment. Does anybody need to revisit a slide, or does anybody need to see a piece of note again? Does anybody need to see any notes again? Here's the OTE notes. And the star just means topics related to this. Take a quick screenshot. This will also be uploaded into YouTube. I'm going to go to the next slide. This is the next slide. I'm make sure that you guys take a screenshot. Okay. So now I'm going to transfer over to TradingView. And I am actually going to use a little blank slate here for you guys to take a look at this, okay? So we're going to use the Fibonacci retracement. Now, a lot of people have different levels for the Fibonacci retracement, but I'm going to show you guys the levels that I use, right, personally. I'm going to show you guys the levels that are quite important, okay? So the Fib, the actual original Fib, right, it has a couple things. It has, let me actually get rid of the ones that I don't use. There we go. So the Fib normally has a bunch of levels, right? It has like the 618, it has the 382, the 236, right? The 1.1, the -1, and all of these different levels, right? I don't use them. So I'm going to show you what levels that I use, okay? And I'm actually going to blank a couple of these out for now, and I'm going to show you guys the bare bones fibs that you guys need to have, okay? The bare bones. This, I'm going to get rid of this, I'm going to get rid of this, okay? So this is the bare bones fib that you should have available to you at all moments, okay? You should always have this fib available. I'm going to show you what the levels are, okay? The levels are 0, 1, 0 0.5, 0 0.79, 0 0.886, 0 0.705. Some people use the 71, is the exact same thing. Does everybody have this written down or copied? Now, this is different from Zay's classes when he teaches fibs and ranges. I am using something, I'm using the fib a little bit differently, okay? Actually, a lot differently. Make sure you guys screenshot this or write this down. However you guys would like to share this. Does everybody have it? Great. Drop a 1 in the chat if you have it. Drop a 2 in the chat if you don't have it yet and you need a couple more seconds. Okay. Gonna hang on for just a couple seconds. I also dropped it in the chat, like in the Discord. So if you need it in the Discord, I also have it there. Great. Okay. Next, I'm going to show you guys the ones that you need to highlight. Okay, so the reasons why I changed the colors of the 79 and the 88.6 is because that is my kill zone, right? The 705 is kind of my alert, you could say, and tentative entry. Okay, so I'm going to show you guys exactly what I mean by that. Okay, so this little gap right here, right? This little gap right here, from the 79 to the 88.6, right? Right here. This is essentially what I use as my area of entry. Usually I enter right on the 79. If it goes below on the 88.6, sometimes I stack an entry or I, fill in my risk. So essentially, let's say that, I put in half lots at 79. I can enter a full lot at the 88.6, right? So let's say my risk is a 1, right? Let's say that my risk is a 1, is a 1.0 lot, right? At the 79, I can enter 0.50. At the 88.6, I enter another 50. Now, what you also can do is if you want to kind of just aggressively trade and just be in the trade no matter what, you can also add, right, I'm just going to add a real quick condition. If you are aggressive, you may enter at the 0.705 with half lots. Okay. So this is going to be kind of your rule book. Okay. So this is going to be your rule book. So if my max risk is a 0.01, oh, sorry, a 1.0 max risk, I can do either of these things, right? So for me, what I personally do is depending on the time frame, I like to enter on the 705, right, and then scale in on the 79, right? Basically enter half lots at the 705 and enter full lots at the 79. So if my max risk is a 1.0, I enter 0.50 and I enter 0.50, right? And then I don't enter on the 88.6. What I know some people do is they enter 33. They're like, if your max lot is essentially a 1.0, you can do 0.33, right, at the 705, 0.33 at the 79, and 0.33 at the 88.6. Okay, so 1/3 of your total lot size. Now, the reason why I like the 79 and the 88.6 is very simple. And the reason why I even have the 50 here is for my premium and discount arrays, right? So I don't even really use it much. But what you need to know are the 705, the 79, and the 88.6. So how do I personally use them? So whenever I see a trade coming up, right, and whenever I see a trade that meets all of my requirements, I essentially stretch my fib from, you can either do it from the body or from the candle, right? If you're aggressive, you can do it from the wick. If you are a little bit more conservative, you can do it from the candle, okay? From the body of the candle. So either way is fine as long as you do it the same on the other side. So if you're going wick, you should go wick, right? If you're going body, you should go body. You shouldn't go wick to body or body to wick. Usually that's kind of a little bit, I mean, it's just kind of iffy. So I'd suggest you guys, pick one and stick with it. So the 79 and the 88.6 are the two ones where I am really looking at the trade to return to. Why? Because as we said earlier, the theory of extremes essentially says, well, the market prefers these extremes, right? And the market prefers returning to extreme positions so that it can knock out a lot of active positions, get more liquidity, and that way it can trigger orders, right? That are bank sponsored and shoot up, right? So let's actually put a position here. Does everybody have this written down, by the way? Yes. If you do have it written down, can you please put a screenshot in the chat so that other people who do not have it written down, so I can keep moving, can have it in the chat as well. Can you put it in the Discord, please, Denise? That would be extremely clutch. Thank you. That's very kind of you. So moving on, I'm going to give you guys a checklist. Okay. So now that everybody has this written down, I'm going to delete it. Entry checklist. First, the origin. Okay, so the anchor, anchor, or where you first click your fib, right? So the anchor, the fib, I'll put it this way. The fib will be anchored at the first candle that started a move which broke liquidity slash highs or lows. Okay, so that's the first part of the checklist. That's the first part of the checklist. And I'm going to show you why this is the first part of the checklist, okay? So let's go here to our first example. Our first example here is very simple, right? We see this entry we see the market conditions, right? We have our daily target, which is up here, right? So the previous day's high is up here. Now, we see a move, like we see two respective highs, right? We see a high here, we see a high here. So we obviously see that there's liquidity here, right? There's also a previous high. There's also two previous highs back here, which are, minor highs, but they're still important. 5-minute structure isn't the easiest to read, but trust me, it is very helpful for your study because it helps refine your skills on a time frame, which essentially just moves faster, right? And it's a lot more choppy, so that way you guys can understand how the market moves in a lot clearer detail. So we see that the move actually took out sell side liquidity. So remember that sell side and buy side liquidity counting is very important. What does that mean? Buy side and sell side liquidity counting. Well, that essentially means is, do I have buy side liquidity or sell side liquidity active here, right? And a lot of people that are beginners may not understand what that is. Well, I know that above here, right, some people sold. And I know that at this level, some people said, "Oh, there's resistance," or "Oh, there's a doubled bottom," right? So I'm going to buy, right? The people who sold up here maybe got taken out break even, right? Maybe got taken out if they moved their stops too quickly. Some of them that really got the snipe really didn't get taken out, right? So there is still active liquidity here. It might have been mitigated, but again, it's still an active high, right? So we do have some liquidity here. So yes, you have liquidity, right? Now what about here? Again, just like this, it was mitigated. So we could essentially say that this is a low, this is an active high, but it's a significant high, but not an active one. So essentially, it's a significant high because of the simple fact that this high, kept the market structure going, right? It kept a bearish market structure continuing on, right? Now, this right here, why do I say that this is already taken liquidity? So the I that's crossed out, that means that liquidity has been taken. Meanwhile, the dollar sign means active liquidity, right? Why do I say that? Well, because further along, we see that the market actually broke through this level and dipped inside of that liquidity pool. So this liquidity has been purged, right? So where is all the liquidity going toward? Where is this market structure facing at the moment? So ignore this, just look at up to here. Look at up to here. Where is the market going? 1 for bullish and 2 for bearish.
1.
All right, perfect. So everybody's getting it, right? So we have all of this buy side liquidity to take out, right? It has to take this upside or buy side liquidity. Okay, so buy side, let me actually write this down for the people that don't know. Buy side liquidity, also known as BSL, right, is uh, groups of orders found higher than where price is now, usually found at unbroken or unmitigated highs. And unmitigated highs basically just means that the move bounced off of it, right? So in this case, this is a mitigated high and this is a mitigated high. But the reason why I said that it's a significant high is because it has yet to be broken, right? So that's still essentially market structure, right? So if price is to break above this high and then these two highs, we understand that price is going to go where? Up or down? If it breaks above this high and it breaks above these two highs. 1 for bullish, 2 for bearish. 1 for up, 2 for down. Is it going to go up or down? If it breaks if it breaks all 3 of these highs. 1 for up, 2 for down. If it breaks this high right here, right, this relative high, and if it breaks these two significant highs, is it going to go up or is it going to go down? 1 for up, 2 for down. Okay, so for the people that said down, why did you say down? You guys can unmute your mics and talk, by the way. Because price has captured all the upside liquidity, it collected liquidity, down to collect liquidity and back up. Structure was broken to the upside, meaning it was just a retracement. Highs were taken to go back to the upside. Okay, so I think there was a bit of confusion on the question. So what I meant is, where is it going to go in? Like, if we were to take a trade, would we buy or would we sell? Right after it broke those highs. So the correct answer is one, right? That we would buy it. The very simple reason for that is that in this case, right? Give me 1 second. Okay, so when it comes to price moving here, right? We break this high, meaning we did take this buy side liquidity. However, when it retraces, we have established a bullish market structure, right? We already took sell side liquidity. So now there's only buy side magnetizing, right? Since there's only buy side magnetizing this position, we would look for bullish positions. We would look for a bullish position here, right? Now, one of the pieces of the checklist, right? One of the pieces of the checklist that we noted up here was that the fib is going to be anchored at the first candle, which started a move which broke liquidity at highs or lows. Okay. Let's see the example that's given here. So where's the origin of the move that pushed price higher, that broke this high or these significant highs? So this is the move, right? The original candle is going to be this one, or you could have done this one. Either way, it's like either way, it's correct, right? But I would have done this one very simply because it's the first one that actually showed, bullish structure. So I would have put it right around here. Now, if we take our fib, I'm going to take it from the wick. The wick, I'm going to extend it outward. Okay. So I'm going to put it from here to here. And where am I looking to enter? I'm looking to enter at the 79 to the 88.6 level, right? You can use 705 if you would like, but I'm going to enter at 79%. Now, where's my stop loss? My stop loss is going to be exactly at the 1 level. It's exactly at the 1 level. You don't want it a little bit lower. You don't want it a little bit higher. You don't want it anywhere. You just want it at the 1, right? If you would like, you can extend your risk just a little bit more. But usually, if you are correct, you will not be stopped out. Okay. And it should be the origin. So it should not be a retracement. It should not be a retracement, right? It should be the origin. All right. So this here, after that, we're going to turn on basically our targeting. So going back to the checklist, we understand, right, that the fib must be anchored at the first candle which started the move that broke liquidity, correct? The second point, the move resulting should always break structure or a previous or continue structure. What does that mean? Well, essentially what that means is, in this case, right, this move broke structure, correct? This move broke structure. So what does that mean? Can you touch a little on your trading plan? Not right now. I'm doing the class on optimal trade entry. The trading plan is kind of like what I'm giving you guys right now with the checklist. But my personal trading plan, that has to be another call right now because I'm doing a separate one. So with this one right now, right, you guys see how this is a significant high, right? So let's do like a little micro example, right? Let's do a little micro example. Let's delete this real quick. This is the last previous high, right? This is the last high. Great. Since this is the last high, it drops below. And what does it do? It breaks, right? So once it breaks that high, we can fib it from the bottom, which is right around here. We can fib it all the way to the top, and it reaches into our entry, which would have been our position here, our stop loss at the 1, our take profit here, right? Even though this is a micro example, it would have been, 3 pips or 4 pips for 14 pips, right? And of course, this is just a small example that I'm showing now. I'm not showing any of the extensions yet, which I will show in a little bit. But you guys just, remember that essentially that tool belt, right? So go back up here. There we go. Where did it go? Oh, here we go. Okay. So the move resulting should always break structure or continue structure. Basically, all that means is continuing structure just means this. Just means that, like, let's say, price went up and then it broke the high, right? So it's still bullish. It's not reversing anything. All that you're doing is getting a re-entry, right? And you mark your 79, and that's all you'd be doing. That's what I mean by continue structure, right? Next up, we're going to have our third position, right? Do you recommend selling at the top? No, I don't, because you aren't quite certain where the top is. I recommend you sticking to a solid trading plan, right? And saying, no, I'm going to get the entry that's going to do me more good. Because if you're just stressing about the sell, it doesn't need to happen for hours, and you're just going to be sitting there giving your broker money. So I would just let it come back to the buy or the sell area that you're working toward. I wouldn't do the opposite. So the third is, so first we have that the fib is going to be anchored on the first candle, which is the origin, right? Second, the move should always break the highs, right? And third, you should use something called direct displacement, right? So use displacement. Essentially, what using displacement means is this right here. So if you see a move that goes like that and retraces and comes back up and finally breaks the high, okay? What you should be doing is you should be using the origin. You should not be using the point that, the point that retraces again. You shouldn't be using stuff like that. You should be using the point where it originated from. Displacement essentially just means correlate your entry to where price actually made the position for you to enter. Because if you would have done it from here, more than likely you would have gotten stopped out. Very simple reason for that is you fibbed it wrong. Right? So using direct displacement just means be wise about both your time and your price, right? So remember to use it from the origin and be wary about your session, right? So what does that mean by your session? So how I use this, right? How I use this is very simple. I use it for New York Open, right? You can also use it for London Open. You can also use it for whatever you'd like, but I use it for New York Open. However, that's going into a little bit of a sub-series, so I'm going to address that in a little bit, okay? So what we're going to do is the third rule, right, for placing your fib is there should never be liquidity on the opposite side. There should never be liquidity on the opposite side. Basically what that means is, let's put a visual example, right? Let's say that you are trading, a position where there's a huge liquidity void, right? And then price retraces and then it comes back up like this, and then it's doing that. Should you take this buy? Should you take this buy? Should you want to buy at this position? Is it safe to? Could you? Yes. Is it safe to? No. right? It's not really safe to, because more than likely what can happen here is you'll get a couple pips in profit and boom, right? All of this will get filled in because that's going to be the hierarchy of price, right? So there should never be liquidity on the opposite side, okay? There should never be liquidity on the opposite side. If there is liquidity on the opposite side, meaning that there is, an inefficient candle, there is a price void, stuff like that, then you should never use it, right? In this case, do we see any inefficient pricing? Do we see anything inefficient? Not that hasn't already been mitigated. Look at this. Mitigated, 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 right? Definitely mitigated, mitigated. Everything's mitigated. So there's no inefficient price action here. Therefore, you should always be looking for efficient price action when looking for this. Okay? It should never be liquidity in the opposite side. And let me actually go back to my lesson plan to make sure I have all the rules written down at the moment. Okay. So how you can use this, right? So this is going to be the general plan for optimal trade entry. Okay, this is the general plan. The reason why I say this is the general plan is because I want you guys to understand that there are certain ways that you can use the optimal trade entry that work every single day, right? You don't have to concern yourself with complex systems or complex anything like that. This is what you can understand and that you can trade every day. Okay, and I'm going to show you guys this in just a couple minutes. So firstly, there should never be liquidity on the opposite side. And then next, oh yes, um, your TP1 should always be the 0 level. Okay, so it should always be the 0 level or the level that the move ends, right? So where's our TP1? Right where the level ends, right? So it starts right here, it ends right there. Very simple. Does that make sense? Drop a 1 in the chat if that makes sense. Now this is where we move on to the next part. The next part is this. The next part is the Fib extensions, okay? The Fib extensions work like this. 1, negative 1.5, 5, negative 2. Here we go. Okay. So what you can do at this point in time, right, is you guys can bust out your Fib extensions. And how you guys use your Fib extensions is very simple. You just add the levels, right? That's all you really do. Just add the levels. So whenever you're looking at a trade like this, and you guys can adjust them very simply to these different levels. Let me see the other ones that I use. If you guys want to add some, you guys can add these two, but they're not essentially needed. So you guys can use these levels, right? And these Fib extensions will help you take partials, right? So what are partials? Essentially, when you enter a trade, right, you have a certain amount of lot size that you have placed. Yes, these are the levels that I have. Just use the ones that are checked. The other ones are irrelevant. Everybody have a screenshot? The extensions are standard deviations? Yes. Ish. Yeah. They're standard deviations by just saying like, okay, well, this is, the 1, the 1.5, the 2. So it's basically split by 0.5. Okay. So at each one of these, let's say that you trade at a 1.0, right? Let's say that you have a 1.0. Right here, you would take a fourth of your profit. Or if you want to be a little bit more conservative, you can take half your profit, right? And then from there you can let the rest ride, right? But remember that your target should always be a significant price level. Let's see what actually ends up happening in this trade. Your first take profit gets hit, so you already have half of your lot sizes already placed, right? You already have half of your lot sizes already taken. The point of this is for you to make sure that your price, right, that your trade gets at least to the zero. That's why I'm saying, okay, well, if you want to take off half of your lot sizes here, that's completely fine. Then the rest you can let it ride, right? Because if it comes back into break even, you should have already moved your stop loss at this point, right, to a significant point of structure, basically saying, okay, well, I already took half of my profit. I'm not going to keep my stop loss here. If you keep your stop loss there, you're just inviting the trade to come back and take away your profit. So what should you do? Your next stop loss should be, well, we see that price comes up here. We see that it comes back and retests. Okay, then I should probably put it around here, right? Because this has already been retested. So this is going to be my new stop. Okay. Now continuing forward, it hits your second take profit. Now I can move my stop loss a little bit further up. Well, some people like to just use the zero as your new stop loss. That's fine too. Or you can just put it, beneath a certain level. Now your third take profit gets hit. So what can you do? Well, for me, you'd move up your stop loss a little bit more. I'd probably move it up to here or up to here. And let's see what happens. So you've already taken, how much profit have you already taken? How much profit have you already taken? You've taken half your lot sizes. You've taken, let's say you take another 25% of your lot sizes and these two, right? Which means that you only have another 25% left to take, right? So you have a half of 25% and another half of 25%, right? So right up there. You've already almost closed out almost all of your trade. These are just runners. Now you'd like to move your stop loss up here, right? You move it down here. And there you go. The trade is done. You've gotten taken out break even. Your last take profit barely got missed. By that point, you probably should have manually closed out some of your lots. But at that point, right, you've already secured half, 75%, about 80 to 85% of your trade has just been coming to profit. That doesn't mean you completely closed out at the two, but your stop loss is protected, meaning that you are completely protected from this trade and you profited about 80%, 80 to 85%. Okay. The market traumatized you, you're closing at first TP. Oh yeah, I mean that's fine. That's fine too. You definitely can do that. You don't want to get greedy at all, right? But I'm just showing you, right? These Fib extensions can show you where the market can possibly go toward, right? I did have different ones, but they're very similar. Now, this is not just something that happens once, right? This is not just something that happens every so often. It happens every day. Okay. And the last couple moves is the last couple rules is just 5, move your stop loss up to protect your trade every time you take profit to a significant price level. And the reason why I say significant price level is because a lot of people just try to move their stop loss wherever, right? And when they move their stop loss wherever, well, boom, right? They get taken out. Why? And they're like, oh, why'd I get taken out? Well, very simply because you moved it in the wrong place, right? You should place it somewhere that you know that market structure is broken at that point, and it's going to go towards your origin at that point, right? You shouldn't just be putting it somewhere because it looks nice, okay? And the last one is just make sure to close partials. Okay. That's essentially what it should be. So if it goes back to the zero, or maybe if it's a little bit below the zero, perfect. Take your profit, right? And always protect your entry. So just because, like, let's say it's all the way up here, you shouldn't have your stop loss still at the one. You should have it a little bit higher, or at least to break even. Right? You should not leave your stop loss for it to just take liquidity in the market. Okay. So this is going to be your entry checklist, right? So the fib is anchored at the first low that broke liquidity. The move resulting should always break structure in order to continue and then begin a retrace that holds bearish structure. Okay. There should never be liquidity on the opposite side. TP1 should always be at the 0 level, and make sure your stop loss is moved up in order to protect your trade every single time, and make sure to close partials. Does everybody have this? Does everybody have this? Drop a 1 in the chat if you have this. Drop a 2 in the chat if you don't have this, but I'm going to put it in the chat anyway. I already put it in the chat, so just go ahead and download it from there. Just screenshot it from there. Cool. Awesome. So we have reached the end of this class. However, I'm going to drop a couple nuggets for you guys after this. This is the basics, right? This is the basic. This is how you should do it, right? This is how it's supposed to go. There's a couple things, right, that you guys can do to make sure that your trading elevates to the next level. Okay. And very simply, it's using something called the New York Open, or time price efficiency, right? Time price correlation. So here, whenever, can anybody tell me what time is New York Open? 6 a.m., 7 a.m., right? Well, I'm not sure what time zone you guys are talking about, but it is around 8 to 8:30 Eastern time. I usually kind of clock it at 8 Eastern time, right? Because the kill zone is between 8 and 11 Eastern time, right? 8 and 11 Eastern time. Or 8 and 12. Yeah, 8 and 12 works as well. The kill zone is between 8 a.m. It's going to be between 8 a.m. So I'm doing it like that this way. Put it like this. Let me put it like that. 8 a.m. And it should be around 12 a.m. Here we go. Right. So this is our New York session. Well, this is our New York kill zone, right? This is our New York kill zone. Do you guys see how it went up? It retraced before it actually came back up towards New York. Well, in this case, this is our retracement. This here could have also been, right now this was London. So this was a bit of a micro example, but this would have been the same for London. Oh, now that you guys see the extensions, I want you guys to see this, right? So now that you guys see the extensions, right, you could have gotten it at the 79 right there, 4 pip stop. Let's say you went for all 50 of these pips that it offered, right? Well, fortunately, you would have caught them, right? So just as a little bit of an example there, you could have seen it. What time does London open now that we are in daylight savings? It opens at the same time at 3. So London opened, it retraced, and it came back up. London opened right there. You see the previous high that broke liquidity, and it shot all the way back up, right? And now that led to New York Open. New York Open is at 8. So if you guys want to use the New York style, right? It's going to be at NYO, which is 8 a.m. Eastern time, right, to 12 noon Eastern time. Okay. So that's New York Open. Now, what you're going to do every single day, right? What I want you guys to practice is I want you guys to look at market structure in London, sorry, in New York Open, right? So 8 a.m. that should be doable for everybody. 8 a.m. right? And now I want you guys to see market structure. I want you guys to observe as market structure breaks either the previous high or the previous low, okay? And then from there, I want you guys to fib out the retracement and try to catch buys or sells from that, okay? Now, this works for all pairs. It just works especially well for pairs that move a lot during New York session, okay? Should we set the charts to what time you have in the bottom right? UTC4 is just New York time. Just New York time. I mean, that's where I'm located, so that's just where I have it. You guys can use a time converter just to see what time you guys need to wake up if you guys are not in the East Coast US. If you're in London, add 5 to this. I think most of London is 5 to this, or well, I know that's like Leeds and like Bristol or something, right? I'm sorry. So there's that. Now there's one more rule, okay? You guys should be using, and actually I want you guys to kind of write this down separately, okay? Because this is kind of relative to just this, right? You guys should be using the daily high low close, right? So actually, oh God. Let me just hide the let me hide the drawings. Okay. So as you guys see here, we have bullish continuation, right? We have bullish continuation. Now in this case, we see that the open here, we want to go for another basically another iteration higher, right? So what you guys can do is in normal structure, right? For example, like this, you guys would want to go to break the high. You guys would want to break this high right up here. You guys would want to break this high. You guys would want to break, this high. So when it retraces back down, your target would be at the previous day high, right? Using the previous day high, but you can also use, your fib extensions to continue calculating higher. Now the reason why I put mine right here is because I realized that there was, bullish structure. Let me go ahead and add that again, right? There was bullish structure from here, meaning that I can use these previous candles as targets. I just kind of used the one that correlated. So the one that was here correlated to this one, the one that was here correlated to this one. So I was just kind of showing, like, okay, well, I'm starting off at this position. Let me target the daily high of the previous candle here, and that's kind of what I did, right? So essentially, you want to use, so every single day that you guys wake up, what you guys can do is you guys can mark the low and the high. So the low and the high. So let's say like we're doing it here, right? It would be this low. I can't edit because it'll actually like screw my chart up. But you'll mark your high, right? And you'll mark your low. You'll zoom into the 5 minute, 15 minute, whatever you want to use. I usually use the 5, right? And then you'll watch how structure reacts, right, around a certain position, around your kill zone. So around 8, right? Around 8, and then from there you'll wait for your retracements. Right? You'll wait for your retracements. And once you wait for your retracements, then from there, all you need to do is use, use the fib to retrace it and to see which move actually, purge the low or the previous low, and then from there you guys can use it yourselves. Does that make sense? Bring back the edits. That makes sense. So you guys want to do this you guys want to wake up around 7 Eastern time and just analyze your charts, right? And then have your entry kind of already formatted by the time 8 hits so that you guys can just watch how the market moves. And then from there, guys, even just hitting 50 pips a day, 50 pips a day is super easy to hit. Okay. Okay. Can you repeat that? Okay, kind of confused. I'm not sure how to use lower time frame. So lower time frame is going to be using the exact same is going to be used the exact same way as higher time frame analysis. It's going to be almost the exact same. You just need to see where the significant highs are, meaning this, and you guys need to see that okay, 8, right? New York opens, price pushes higher, breaks the high, creates bullish market structure, retraces, you fib it, right? And when it retraces, you find your 79 key level, and then from there you take the buy from there. Okay. So it'd be the exact same way in other pairs like AUD USD, NZD USD. All the things that you guys would be doing is just watch for significant highs, watch for significant lows. In this case right here, right, it dipped. So let's say that it keeps dipping. Well, this price broke its previous low, didn't get a full retracement, so we don't enter. In this case, right, it did actually break the low here, so this could have been another technical one, right? So here's the previous low, it broke the low and it retraced. So if you would have fibbed that, it would have hit your 79 perfect, and then you would have dropped it all the way down, right? How to use lower time frame in order to in relativity to the previous high or low. Okay, so all that I'm saying there, and I don't want people to get confused, all that I'm saying here in terms of the high and the low, right, is you should use that as a target. Okay, you should use that as a target. For example, let's say we go to this to the whiteboard. To answer a question in the chat, I'm not talking about institutional sponsorship right now. We have to stay on track. So in this case, right, let's say that the previous high of the day, let's say this, right? Let's say that we're in a bullish structure, right? Let's say we're in a bullish structure. And we see that price right here. The previous daily candle is like this, right? And we open here. Now, when we open, we dip a little, right? We dip. So when you dip, that's perfectly normal, right? Perfectly normal for a candle to dip on open, right? So it dips. Now from here, what's the high? High is this level. So this is going to be your target. This is going to be one of your targets, okay? Now from here, if you zoom into this on lower time frames, let's say you see something like, and then New York opens here. Right? Let's say that New York opens right there. So in this case, you see price return. You see that, let's say an institutionally sponsored move comes up and breaks these highs. So it took all of this liquidity. So now you know that most likely we're going to be distributing upward. Now it returns, right? You fib it, 79 somewhere around here. You enter your buy with your stop loss back here. And you watch as price reaccumulates and goes higher. Right now, let's say that your target line is somewhere around here. Let's say that your target line's up there. Cool. At that point, you can very easily just say, okay, my target has been hit. I'm going to TP. Or you can easily say, okay, well, I'm going to secure half lots. Okay. And either or is perfectly fine. Okay. Either or is perfectly fine. All that it should be is really just a target, right? Because rarely will price ever close like this and then the next day like this. Rarely, right? Usually on the daily time frame, it closes, right? It closes like that, or it'll close like this, right? Either way, it's going to go in one or the other direction. All that you need to do is you need to have these daily highs and these daily lows as targets, okay? And then you should watch how price action affirms itself on the 5 minute, right? Or on the 15 minute or on the 10 minute, however you want to use your lower time frames. And then from there, you want to enter on confirmation, right? With your optimal trade entry, and then use this here. Let's say you use this here as your target. Does that make sense? Drop a 1 in the chat if that makes sense. Great. Okay. So now what I'm going to challenge you guys to do, right, is I'm going to challenge you guys to wake up for a New York Open right at 8 a.m. I'm gonna want you guys to wake up with me, right, before New York, and I want you guys to see where the market is going to retrace to, right, and what your daily target is. So let's say that you're on AUD, USD, or whatever else, right? Let's say that you're on another pair. Cool. Well, mark your daily high, mark your daily low, and then watch how price reacts. If price is moving in a bullish fashion, then look for bullish retracements into a buy. Right? If it's moving in a bearish fashion, then look for bearish retracements into a sell. Okay? in some time zones, New York session will be at nighttime. Okay, that's fine. Just make sure that you're trading, and if you can't, that's completely fine too. This works the same way for London. You just need to basically just whenever you trade, just try to look for this. This works even on higher time frames too. So if you're looking to trade it on higher time frames, you can just as well trade it on higher time frames. Just make sure that you follow the plan that I set out earlier, right, where it says moving your take profit. So the fib should be anchored. All of this, you guys should be following this if you guys are using if you guys are using it outside of this conditional time. So if kill zone is at 8, start looking at 7. Usually I do, yes. So usually I wake up for New York around 6. But that's just me because I like getting my morning started and everything like that back when I was a healthy sleeping person. But now I do not. So, you know, all right guys. So is there any more questions? Next time I will be doing a little bit more in depth into the New York time zone moves, but I want you guys to take what you guys learned today and I want you guys to apply it in the market this week, the rest of this week, and please back test it, okay? I'm going to be uploading this video on YouTube. And if you have any questions, if you're watching on YouTube, please do not hesitate to comment your questions and I will get back to you as soon as I can. You trade EU and GU at London? Yeah, those are London pairs too. Um, will you be trading in the morning? I'm not exactly sure. Not quite sure yet. My sleep schedule along with uni is a little bit difficult, but I will try to. Our channel is Empire Trade Group. Okay. That's about it, guys. If you guys have any questions, I'll be answering them in the Discord. I appreciate everybody for hopping on, and I hope this has helped you or will help you in the future. Okay, so make sure I'm challenging you guys to use the New York the New York opening theory, and please make sure that you guys do it and come back with your results or your questions. All right. All right. Thank you, guys.